Guys, welcome to Unisys Weekly Fundamental Analysis. First of all, we're looking to the dollar. The dollar index closed down by 0.38% this week to 91.610, but hit a record high of 92.506 since late November last year. US Treasury yields rose nearly 6 basis points on a weekly basis for 6 consecutive days, on once again set a more than 1 year high to 1.640%. Boosted by optimism about the US economic outlook, it is also limited the dollar's decline. So the US President Biden signed a 1.9 trillion economic stimulus bill on Thursday and urged the US states to make all adults eligible for the COVID-19 vaccine before 1st of May, which will give the United States the economy inject a booster for the economy. And next, the Federal has no urgency to control yields. The Federal's 2 days policy meeting to be held next week. Given that Federal Chairman Powell did not express concern about the rise in US bond yields last week, the market has low expectations for announcing major policy adjustments. The Federal clearly believes that any increase in inflation is temporary, and the tighter financial conditions so far are not worth taking action. So the UBS strategy said in a research report, the rise in US Treasury yields has supported the US dollar, and the Federal stance is still moderate. But the Chairman Powell has chosen not to verbally suppress the rise in the yields, which has provided a further short-term boost for the US dollar. And next we'll look into the euro. So the euro closed up 0.37% to 1.1961 against the dollar. However, the intraday hit a new low of 1.1835 since late November last year. The European Central Bank said on Thursday that it would speed up the printing of money to prevent the Eurozone bond yields from rising. So the latest statement of the European Central Bank suggests to skeptical markets that the central bank is determined to lay the foundation for a solid economic recovery. According to surveys, the upward momentum of inflation in Eurozones are likely to last. The slow recovery of the economy from recession triggered by the epidemic will make price growth lower than the ECB's target for many years. Alright, furthermore, we're looking to the pound. So the Britain's GDP expected to return to pre-COVID-19 levels within 2 years. Wow. So the pound rose by 0.6% to 1.3929 against the dollar. And the pullback momentum of the previous 2 weeks ended. The pound's previous weakness was largely due to rising US bond yields pushing up the dollar. The themes that have driven the pound to rise include the progress of the UK vaccines, the plan to relax the blockade measures, and the expected cooling of the Bank of England's implementation of negative interest rates. So although the UK has the highest number of deaths from the COVID-19 in Europe, the country's performance in vaccines is better than other countries. The number of people receiving the first dose of vaccine in the UK currently exceeds to 22 million persons. So as part of the UK's relaxation of the lockdown plan, schools in England opened on Monday. This is the first step to return to normal. So lastly, we look into the gold. Spot gold closed up by 1.57% this week at $1,726.69 per ounce, and the week ended 3 consecutive negative periods as the US dollar index closed down. However, the gold price refreshed its low point since early June last year to $1,670.50 per ounce. Biden signed a 1.9 trillion COVID-19 bailout bill, and the speed of vaccine promotion is expected to further increase. The Federal is not worried about a rising inflation. The yield on the 10-year US Treasury bond hit a new high in more than 1 year, increasing the holding of non-yielding asset gold opportunity cost. So next will be the forex calendar for next week. So as usual, friends who are going to trade, remember to set your stop loss, as whenever there's news, there'll be more fluctuation. Alright, so that's all for today. Thanks for watching.